The yield curve just inverted. Are we headed to a recession? Are we in clear waters? Let's get into it. Hey guys, welcome back to another video. It's Luke with The Common Investor here. If this is your first time visiting the channel, we discuss different financial news, investing strategies, and tips and tricks. So if that's something that you're interested in, feel free to hit the subscribe button and with the bell notification for all our future videos. In today's video, I want to discuss something very serious, and that's going to be if we are heading into a recession or not. On the last trading day that we just had there on Friday, the yield curve inverted. If you don't know what the yield curve is, we're going to be getting into that. If you don't know why the yield curve inverting is a bad thing, we will get into that as well. And then I'll also discuss my personal take on if we're headed to a recession or not. So what the yield curve is, it's a curve on a graph that plots fixed rate securities against the length of time before their maturity. And now on a normal healthy graph, when you have 1 month to 1 year securities, the interest rates are going to be a little bit lower than the ones that are 20 or 30 years. They'll be a little bit higher just based on the amount of time. There's a little bit more risk involved in investing in longer term notes and bonds. So that's why those interest rates are usually higher. Now, what can happen sometimes is that the shorter maturity securities can begin to have a higher yield than the securities with a longer time before they mature. So what you can have, for example, is a 1 month note might have a higher yield than, let's say, in a more extreme example, a 30-year bond. Now, in a normal, healthy graph, like I said before, the 1 month bills will be significantly lower than the 30-year bonds. Now, what would cause these inversions is because the market sets the yields. They believe that the market isn't going to continue with the growth they have, and it's a little bit more riskier to hold shorter, time to maturity notes or bills or bonds than it is to hold longer to maturity, notes, bills, or bonds. Now, the reason that the inverted yield curve is actually a really bad thing is that it's one of the best predictors of recessions for the past 60 years. Out there. It's actually predicted the last 7 recessions. Every time that the yield curve has inverted, the market has gone into a recession shortly thereafter. Now, I'm not saying it's going to be going into recession tomorrow or even a couple months from now. The average I was looking at between when the yield curve does invert for 10 days in a row is 300 days. So it takes about 300 days from the 10th day that the yield curve is inverted for a recession to occur. Now, that's about a year if you didn't know how to do math. Usually when these things do happen before recessions, there is an uptick in the market. I'll attach a graph here. It's going to show the last 3 recessions. And as you can see there, the yield curve does go below and inverts there. And then shortly thereafter, you'll see the recession. So the past recession there we had was 2008. You'll see that there, that it inverted in late 2006 and early 2007. And then, at the end of 2007 is when the recession started. And then obviously 2008 was the main force of it. You'll also see there the, 2000, tech bubble. And then you'll see the early recession in the early 90s. Each and every one of those, the yield curve there inverts, and then obviously the recession does happen. So it does look like it is a pretty strong indicator, especially if it's done for the past 7. So that is something definitely to note in your investing strategy moving forward and kind of how you're going to position your portfolios. Now, in my personal opinion, do I believe that a recession is right around the corner? The short answer is yes. I do believe that we are probably headed towards a recession for the sole fact that the yield curve is such a big predictor of these recessions. However, I don't think it's going to be tomorrow or the next few months. I think it's probably a year and a half, 2 years out. So I'm thinking maybe mid 2020, end of 2020 is when we'll kind of see that. I don't believe it's going to be as big of a recession as, the 2008 financial crisis. There were a lot of just, bigger factors included with that made it such a drastic drop. I'm thinking we're going to see maybe like 40-45% drop there at most. Nothing over 50. I could be wrong. There could be something, churning in there that's going to really, accelerate the amount of downturn. But I don't see this happening within the next year or until for another year and a half, 2 years. So positioning my portfolio moving forward, I'm definitely going to be investing more heavily into dividend yielding stocks. Probably going to start to, with my trading strategy. I'll include the video there in a card. I believe it's going to be right up there. I think I'm going to try to get, more of the blue chip companies, kind of get out of those riskier trades, and hold, probably 20% cash about, and then just, as I said before, kind of go for those dividend yielders. Probably won't be investing any more money into my Robinhood portfolio. I'm going to do my $20 a week deposits into M1 Finance, shooting for more of those SPHD, Coca-Cola type companies with the high dividend yielders, with lower volatility, just to, keep money coming in, even if the recession were to happen. Now, one last disclaimer before I end the video here is I'm not a financial, advisor by any stretch of the imagination. So, take my word for a grain of salt, always do your own research. So that's going to be it for the video. If you like the video, feel free to give it a like and let me know in the comment section below, what do you think, is upcoming for the, stock market? Are we headed to a recession there within the next couple of years, or are we, smooth sailing for another 10 years, another 10-year bull market? So that's going to do it for the video, and I will see you guys in the next video. Thanks.